In 2008, millions of people believed they were financially stable. They had jobs, mortgages, retirement accounts, and a sense that the system beneath them was solid, enough to carry their plans forward. The streets looked normal, stores were open, salaries were deposited on schedule, and yet underneath that surface calm, something structural had already begun to fracture. What makes the 2008 financial crisis so instructive is not just the scale of the collapse, but how invisible the risks were to ordinary participants. It was not chaos that caused the damage, it was confidence. And that distinction matters when we examine personal money systems today. At its core, the 2008 crisis was not a story about greed in isolation, nor was it simply about banks making reckless decisions. It was about interconnected systems built on assumptions that housing prices would continue rising, that debt could be rolled forward indefinitely, and that risk could be redistributed without consequence. Mortgages were bundled into complex financial instruments, sold across global markets, and rated as safe because models suggested widespread default was statistically unlikely. On paper, the math appeared stable. In practice, the math depended on conditions remaining unchanged. The psychological layer is where the lesson becomes personal. When outcomes appear predictable, humans anchor their decisions to recent history. If home values have increased steadily for years, we subconsciously treat that growth as a baseline rather than a variable. Behavioral economists describe this as recency bias, the tendency to overweight recent trends and underweight long-term cycles. In 2008, homeowners borrowed against rising equity, lenders loosened standards based on past performance, and investors relied on models calibrated to a narrow window of prosperity. The system did not collapse because people ignored risk entirely. It collapsed because risk felt abstract, while rewards felt immediate. Now consider how this parallels personal finance decisions. Many households today operate on assumptions that income will remain stable, that credit will remain available, and that market growth will continue on average. None of these assumptions are irrational, but they become fragile when they are treated as guarantees rather than probabilities. The crisis revealed that when multiple actors depend on the same optimistic projection, small disruptions amplify quickly. A slight increase in mortgage defaults affected bond values, which pressured banks, which tightened credit, which reduced consumer spending, which increased unemployment. The chain reaction was mathematical before it was emotional. If we examine the numbers more closely, the fragility becomes clearer. Imagine a homeowner with a mortgage requiring 30% of monthly income. If income drops by 20%, the mortgage does not adjust downward. The fixed obligation becomes 37.5% of the new income level. Add credit card payments and car loans, and the margin of safety narrows further. This is not dramatic speculation. It is arithmetic. During the crisis, millions discovered that their financial systems lacked buffers. The issue was not lifestyle extravagance in every case. It was structural tightness. Another important dimension is leverage. Leverage magnifies both gains and losses because it introduces borrowed capital into the equation. If you purchase a $300,000 home with $30,000 down, you control a large asset with relatively little equity. A 10% increase in value raises the home to $330,000, effectively doubling your equity, from $30,000 to $60,000 on paper. However, a 10% decrease erases that equity entirely. The symmetry is precise, but emotionally it feels asymmetrical because gains feel like progress, while losses feel like shock. In 2008, leverage turned moderate price declines into solvency crises. The broader economic system absorbed these shocks unevenly. Large institutions with diversified holdings and access to emergency liquidity had tools unavailable to individual households. Governments intervened to stabilize credit markets. Central banks adjusted interest rates, and regulatory frameworks were re-examined. Yet for families facing foreclosure or job loss, macroeconomic stabilization did not reverse immediate consequences. This highlights a structural asymmetry that still exists. Systemic risk can be socialized, but personal risk often remains private. What does this mean for personal money systems today? First, it suggests that resilience is less about predicting crises and more about designing margins. A household that spends 95% of its income in stable conditions may feel comfortable, but mathematically it operates with minimal flexibility. A household spending 70% retains optionality. The difference is not only lifestyle, it is volatility tolerance. In engineering, systems are designed with safety factors to account for unexpected stress. Financial systems, whether global or personal, require similar buffers. Second, the crisis illustrates the danger of complexity without comprehension. Many investors in mortgage-backed securities trusted ratings without fully understanding underlying assets. On a personal level, complexity appears when individuals accumulate financial products they cannot easily model in their own minds: adjustable rate loans, layered subscriptions, variable interest debt, or speculative investments tied to narratives rather than fundamentals. Complexity itself is not inherently negative, but opacity reduces control. There is also a psychological identity shift embedded in this lesson. Before 2008, homeownership was widely framed as a near-universal path to stability. After the crisis, perceptions shifted toward a more nuanced understanding of risk, liquidity, and diversification. When identity is tied to an asset class or income level, volatility feels existential. When identity is tied to adaptability and cash flow management, volatility becomes a variable rather than a verdict. The difference is subtle but consequential. Historically, financial expansions and contractions have occurred repeatedly, from the Great Depression to the dot-com bubble. Each period differs in catalysts, yet similarities persist in leverage, optimism, and delayed recognition of structural weakness. The value of studying 2008 is not to anticipate identical conditions, but to internalize patterns. Systems expand during stability. Risk perceptions compress, buffers shrink, and then an external or internal shock reveals underlying tension. On an individual level, the enduring lesson is mathematical humility. Income streams can change, asset prices can fluctuate, credit conditions can tighten. Designing a personal system that assumes variability rather than permanence reduces dependence on favorable conditions. This might involve maintaining liquidity, limiting fixed obligations relative to income, diversifying income sources where feasible, and regularly stress testing assumptions by asking how the system performs under less favorable scenarios. The 2008 crisis was not solely a story about failure. It was a demonstration of how interconnected systems respond to stress. It revealed that stability is often a product of alignment between expectations and reality, and when that alignment shifts, consequences cascade. By examining those mechanics calmly and analytically, we can treat history not as a source of fear, but as a blueprint for structural awareness. The goal is not to avoid all risk, because risk is inherent to growth, but to understand how leverage, psychology, and margin interact within a system. In that understanding lies a quieter form of resilience, one grounded not in prediction but in preparation.